Have you ever been watching financial news and heard terms like bull market, IPO, or market cap thrown around and just thought, okay, can we get a translation here? Financial jargon can feel like this exclusive club designed to keep people out. But today, we're changing that. In this explainer, we're going to slice right through all that noise and break down the market's essential terms into plain English.
Welcome to the Explainer. Consider this your essential lexicon of the stock market. Whether you're actively building your financial literacy or maybe you just want to brush up on the fundamentals, honestly, going back to the foundational definitions is often the absolute best way to clear away the noise. So, let's lock in these concepts.
Here is our roadmap for today. We'll be looking at 1. The stock market basics. 2. Company value and IPOs. 3. Market moods and volatility. And finally, number 4, the long-term master plan.
All right, Section 1, the stock market basics, the marketplace and what you're actually buying.
So, it all begins right here with the stock exchange. Now, in the past, this was a chaotic room full of people shouting and waving paper around. But today, it's a massive, highly regulated digital marketplace that connects buyers and sellers at the literal speed of light. And if you're operating in India, the two central hubs where all this action happens are the National Stock Exchange, the NSE, and the Bombay Stock Exchange, or BSE.
When you buy a share or a stock, you are literally buying ownership in a company. Actually, think of a company as a massive pizza. If that corporate pizza is divided into exactly 100 equal slices and you buy one slice on the exchange, well, you now own exactly 1% of that business. You own a slice of their assets and a slice of their future potential.
Moving right along to Section 2, Company Value and IPOs, entering the market and measuring size.
This brings us to the IPO, or initial public offering, and this is a massive milestone. It's the exact moment a private startup, which up until now was funded only by founders and private backers, unlocks its gates to the public. It's the very first time they offer those pizza slices to everyday investors. Basically, they are officially going public.
But once a company is public, how do we measure its true size? Well, enter market cap, or market capitalization. You see, you can't just look at the price of a single share to know how big a company really is. Market cap cuts through that noise and calculates the total, massive footprint of the company in the marketplace at any given second.
And the math behind market cap is beautifully simple. You just multiply the current share price by the total shares the company has issued. So let's say a single share costs 100 rupees, and there are 1 crore shares out there. That's 100 crore rupee market cap. That right there is the total calculated value of our corporate pizza.
Section 3, market moods and volatility, the behavior of the market.
The market is deeply driven by human emotion. A bull market means prices are charging upward, fueled by confident, optimistic investors buying in. On the flip side, a bear market means prices are falling and fear kind of takes over. A really fun way to remember this, a bull attacks by thrusting its horns upward, right? While a bear attacks by swiping its claws downward. Caught in the crossfire between those bulls and bears is volatility. Now, volatility is simply a measure of speed and turbulence. When you're looking at your financial apps and you see those wild, erratic roller coaster charts, the steep drops followed by rapid spikes, you are looking at high volatility in action.
And volatility connects directly to your personal risk. High volatility means prices are swinging wildly, which definitely increases the chance of your portfolio dropping in the short term. But it's a double-edged sword. Those same wild swings can actually create opportunities for higher reward. So understanding this just helps you calibrate your own comfort level with risk. And finally, Section 4, the long-term master plan, benefiting and building wealth.
One of the absolute best ways you benefit as an investor is through dividends. Remember, you are a part owner. A dividend is essentially a slice of the company's profits paid out as a cash reward directly to you, the shareholder. Honestly, think of it as a personal thank you payment from the business dropping straight into your account just for holding on to their stock.
So, as you acquire shares and earn those dividends, you are building your portfolio. Now, your portfolio isn't just a simple list. It is the master overview of your entire financial journey. It's the collective term for the whole shebang, absolutely every asset and investment you own.
And for most investors, the core building blocks of this portfolio are actually quite simple. You have your individual stocks, those single slices of specific companies, and then you also have mutual funds and ETFs, which are essentially prepackaged baskets holding dozens or even hundreds of different stocks all at once. Layering these assets together, that is how you construct lasting wealth.
Now, if there is one
absolutely crucial takeaway from this entire explainer. It is this. The stock market fundamentally rewards patience. While the media loves to fixate on quick, volatile trades, true wealth is forged by acquiring good companies and just holding them for years. Think about it. You don't plant a seed and then dig it up every single day to see if the roots have grown, right? You have to give it time to compound.
Which brings us perfectly to a core philosophy of finance. Investing is a marathon, not a sprint. Success in the financial world requires serious endurance. The most successful investors out there pace themselves, they totally tune out the daily noise of the bulls and the bears, and they keep their eyes locked on a finish line that is literally decades away.
So, you now have the fundamental lexicon of the stock market. We stripped away all that jargon and revealed the mechanics underneath. But knowing the language is just the starting line. The real question is, now that you know exactly how the machine works, how are you going to put your money to work today? Start small, stay patient, and start your marathon. Thanks for joining me on this explainer, and I'll see you next time.